All right, let's get right into the crime scene. We are looking at a company that just posted its 16th consecutive quarter of record revenue.
16 in a row.
16! They raised their full-year guidance, they have zero debt, and yet the market decided to take the stock out back and absolutely hammer it.
It was a bloodbath, an absolute bloodbath.
We're talking about Agilysys, ticker AGYS. It is January 26, 2026. The stock closed the regular session near highs around, what, $113?
About that, yeah. Then the earnings print hit at 4:30 p.m.
And it instantly tanked 14%. So our mission today is simple. We need to figure out if the market is broken or if this company is hiding a disaster.
Well, it's a classic case of what we call perfection pricing.
Explain that.
When a stock runs up 5.5% right before earnings, the market is basically saying, this better be flawless. Agilysys delivered great, but, they didn't deliver flawless.
And that gap is where your portfolio goes to die. So let's strip this down. We have the earnings transcript, the raw data. Help me understand the disconnect here. On the surface, the numbers look solid. Revenue came in at $80.4 million.
Right, and consensus was looking for about $79 million.
So that's a beat, a clear beat. They grew the top line over 15% year over year. Why is the street reacting like the building is on fire?
Because not all revenue is created equal. You have to look at the mix.
Okay.
The good news, and it is very good news, is that subscription revenue was up 23%. That came in at $34.9 million.
That's the high margin recurring cash flow, the stuff investors usually drool over.
That's the holy grail. You want that recurring revenue to keep climbing.
And it is. It's now nearly 65% of their total pie. That sounds like the definition of a healthy sauce business model, doesn't it?
It is. The engine is working, but the algorithms, well, they clearly saw something they hated.
And that was the bottom line.
That was the bottom line, or rather, the expectations around it. Non-GAAP earnings came in at 42 cents per share. The street wanted 46.
Hold on. That's it. A 4-cent miss. We wiped out weeks of gains over 4 pennies.
It sounds petty, I know. But you have to understand why they missed. This is where it gets a little technical, but it's really important.
It's about margins.
It's all about margins. Gross margins compressed slightly, dropping from 63% last year to 62.5% this year.
And for a software company, margin compression is a mortal sin.
It suggests you're losing pricing power or your costs are spiraling. That's the fear.
But is that what's actually happening? I was reading the commentary from the CEO, Ramesh, and he seemed to imply this was intentional. He didn't sound like a guy whose costs were out of control.
It is intentional, and that's the nuance the algo traders missed. The miss happened because services revenue spiked 22%.
A record $17.7 million.
A record. Just from implementation services?
So they're making money by sending people to hotels and casinos to install the software they just sold.
Exactly. But think about the economics of that for a second.
Yeah.
Software has massive margins. You write the code once, sell it 1 million times, it scales.
Right.
Services involve people, plane tickets, hotels, hours. The margins are way, way lower.
So because they sold so much service work, which they need to do to get the customers live, the average margin for the whole company got dragged down.
You got it.
This is a suffering from success problem then. They're too busy installing software to show high profit margins right now.
That is the bull case, yes. You are paying a penalty today for revenue that's going to stick around for the next decade.
But the bear case.
The bear case, which is what the market is pricing in, is that this is expense creep. Investors are asking, where is the operating leverage?
Okay, stop there. Operating leverage. We hear that thrown around constantly. Give it to us in plain English.
Sure. Operating leverage is the magic trick of software. It means as your revenue grows, your costs should stay relatively flat. So if revenue goes up 10%, your profit should go up 20, maybe 30%.
That's the leverage.
That's the leverage. But right now, Agilysys isn't showing that. Their revenue is going up, but their costs, specifically the cost of hiring all these people to do the implementations, is going up just as fast.
So the profit isn't exploding like it should.
Exactly. And the guidance didn't really help clear this up.
They raised it. Management actually raised revenue guidance for the full year to the top of the range, about $318 million.
They did, but, and this is the key, they didn't raise the profit margin guidance to match. They kept adjusted EBITDA flat at roughly 20% of revenue.
Which translates to, we're going to bring in more money, but we're going to spend it all immediately.
Precisely. And for a stock that's been outperforming the whole software sector, investors just took that as an excuse to cash out. They want to see the money now.
But there is a massive piece of this puzzle we're not even talking about. It isn't even in those numbers.
The elephant in the room?
We need to talk about the shadow backlog. The Marriott deal.
It's practically a ghost ship at this point. Huge, but you can't quite see it on the radar.
Ramesh explicitly said, again, that the Marriott Property Management System project is excluded from their reported backlog. It's not in the numbers we just talked about, so what's the status there? Because if that hits, a 4-cent miss is just a rounding error.
The update was actually pretty significant. Ramesh confirmed the pilots across the U.S. and Canada were successful. They are done with the testing phase.
Okay, so what's next?
Now they are moving to what he called implementation waves.
Waves. It sounds promising, but it also sounds, vague. If the pilots are done, why isn't this showing up in revenue yet? Why keep it in the shadows?
Because of control. Ramesh used a very specific phrase. He said the rollout is being expertly managed by customer personnel.
Which is executive speak for Marriott is driving the bus, not us.
Exactly. Which means Agilysys can't predict exactly when those checks will clear.
And the market hates uncertainty more than it hates bad news.
That's it. Investors are trying to build their financial models for next year, and you have this massive revenue stream that management basically says it's coming soon, but won't put a number on it. It just creates this information vacuum.
So let me get this straight. The market is punishing the stock for the visible costs, all the hiring, but giving them zero credit for the invisible revenue that those people are being hired to support.
That is the core friction. You see the cost of the Marriott deal today, but you can't see the benefit. Not yet.
It feels incredibly short-sighted. But speaking of uncertainty, we have to address the gaming glitch.
Yes.
Agilysys owns the casino floor. That's their fortress. But there is a stumble in the transcript that felt uncharacteristic.
Yeah, this was the moment where I think some people on the call actually flinched. Ramesh admitted there was a sales slowdown in their gaming vertical, specifically during October and November.
And when the analysts pressed him on it, was it the economy? Budget cuts? He shut it down pretty hard.
He used the 3 words a CEO should never use when describing a revenue dip. I won't speculate.
Oof. That sounds like I don't know, or I know and it's bad.
Right. He called it an air pocket. Now, to be fair, he immediately followed that up by saying sales roared back in December.
For the best December on record?
The best on record. But the damage was done.
But wait, if December was a record, doesn't that prove it was just a timing issue? Maybe people were just waiting for new budgets. Why does that specific phrasing spook the market so much?
Because if you don't know why sales dropped for 2 months, you can't promise it won't happen again next month. It introduces volatility into what was supposed to be the most stable part of the business.
So the algorithm here is unexplained slowdown and just sells.
It doesn't stick around for the "but it got better" part. It just reacts.
I guess that's fair. Opacity in your growth driver, Marriott, plus opacity in your core fortress, gaming, equals a sell-off.
It's the combination of the two. If everything else was perfect, maybe they overlooked the gaming blip. But you combine that with the margin compression. It's just too much noise for Wall Street.
Let's look at the operational side, because there is a detail about AI that actually seemed practical. Usually when I hear AI on an earnings call, I roll my eyes.
Buzzword bingo.
Yeah, but this sounded different.
It was a legitimate use case. They aren't just selling AI, they're using it internal to deploy their own software. Ramesh mentioned using AI tools for data migration, for coding, for configuration.
And the result was weirdly counterintuitive. Their backlog actually shrank slightly. Normally, a shrinking backlog is a huge red flag. It means you're running out of work.
Right. But they spun it as a positive.
And in this specific context, it is a positive.
Explain that.
Think of the backlog as a waiting room at a doctor's office. A packed waiting room is a big backlog. But if you use AI to treat patients faster, or in this case get hotels installed faster, the waiting room gets emptier.
But you get paid faster.
Exactly. They're converting signed contracts into billable revenue more efficiently. That improves cash flow. The risk, of course, is that the sales team has to run twice as hard just to keep the waiting room full.
You can't just be efficient. You have to be hungry.
Speaking of hungry, let's talk about the ecosystem wins. Bolt Farm Treehouse.
A fantastic example. They bought everything. PMS, booking engine, spa module, like 5 other things.
It shows the stickiness.
The stickiness of the platform. Once you're in that deep with 8 or 9 modules, you are not leaving. But the bigger update for me wasn't the treehouse, it was the referenceability.
Grand Slam clients, taking reference calls. Explain why that matters to a listener who isn't selling enterprise software. Why is that a specific bullet point on a call?
Imagine you are the CIO of a massive hotel chain. You aren't going to rip out your old system just because a salesperson has a nice slide deck. It's a career-ending risk if it fails.
You want proof of life.
You want to talk to another CIO who survived the surgery. Precisely. For a long time, Agilysys was selling the vision of a modern cloud platform. Now, Ramesh is saying they have these huge global brands who will get on the phone and say, yes, it works, and we aren't firing them.
That is a defensive moat.
It confirms the product is finally enterprise hardened, and that's worth more than a 4-cent earnings miss in the long run. It means that trust gap is finally closing.
Okay, let's bring this home for the listener's portfolio. We have a stock down 14% in one session, a business growing 15% with a shadow backlog ramping up, but we have margin compression and a weird blip in gaming sales. How do we synthesize all this?
It really comes down to your timeline. The market with a capital M is focused on the margin story today. It sees expense creep. It sees a stock that was priced for perfection and didn't deliver it. That's why it's selling.
But the business capital B seems to be building a massive pipe for future cash flow.
Correct. The stock is just caught in that gap between the promise of the Marriott rollout and the reality of today's payroll expenses.
Which brings us to our favorite segment, the one where we get a little creative.
And the one where we remind everyone, we are not financial advisors.
Not at all.
This is for entertainment and education only. Do not trade based on two voices in your headphones. We are just analyzing the logic of the market.
Absolutely. Do not sue us. We have no money. But if we were pitching a trade to a hedge fund committee right now, based on this disconnect, what's the play? I'm calling this one the shadow backlog arbitrage.
Okay, lay it on me. Let's hear it.
The setup is simple. The market is pricing Agilysys on visible metrics, reported backlog, and current EPS. They are completely ignoring the Marriott deal because it's technically excluded from the data.
So you want to exploit the blindness of the algorithm.
Exactly. The trade is long Agilysys via EPS. For those who don't know, that means long-term equity anticipation securities, basically options that expire in a year or two.
So you're buying time. You're trying to skip over this whole messy implementation phase entirely.
Yes. The margin compression everyone is panicking about today is just the upfront cost of hiring the people to manage the Marriott rollout. Once those waves of revenue hit the P&L next year, the costs are already paid for.
And the margins on that new revenue will be spectacular.
Exactly. So you're betting that today's miss is actually just tomorrow's operating leverage in disguise.
It's a compelling thesis.
You use the 14% sell-off to get into the position cheaper, and you wait for the shadow backlog to finally become visible. When that Marriott revenue hits the books, the stock re-rates, and your lukes go into the stratosphere.
It turns the market's impatience into your advantage. But the risk is real.
Oh, massive risk, of course.
If those waves are smaller than we think, or if that gaming air pocket turns into a full-blown recession, those options go to zero. Leaps are not for the faint of heart.
High risk, high reward. But that's the reality of investing in growth during a transition. You have to decide if the CEO is telling the truth about the invisible whale.
It certainly explains why management sounded so confident, despite the stock dropping. They know what's coming down the pipe. They have $81 million in cash, no debt, and they're buying back their own shares.
So Agilysys delivered the top line, fumbled the bottom line, and confused the street. The question you have to answer is, was that drop a correction to fair value or a massive inefficiency?
Are you buying the 4 pennies lost today, or are you buying the dollars promised tomorrow?
That's the question. See you when the market opens.
Yeah,
This has been Talk Tickers.